Welcome back to this day trading special on Talking Technicals. We were trying to figure out how the Nifty actually works out for day traders, and really, if you look at that neat table on your screens, you will figure out that really it's a very, very interesting and useful tool to use. A, because it's less volatile than many of the stocks. B, because it's extremely liquid, so you can get in and get out without too much cost involved, and you will see good price moves without too much volatility. Also, it's an instrument where you see many options. Even long-dated options are available, so if you want to hedge your portfolio, that's something that you can do on the Nifty futures. And of course, it's one way to participate in the market without having to actually analyze stocks, because indices broadly reflect the momentum and the sentiment of a market at large. All right, so we've spoken about some systems that you can use in day trading, and when you talk about systems, automatically you come to the issue of stop losses. Now, day traders must absolutely act with stop losses, because they are playing for small gains and they cannot afford to give away too much in the way of losses. So if you're looking at the Nifty, for instance, and you're looking at a contract, say at a price of 5,500, it seems like the stop loss on that trade could be in the range of say 50 to 100 points. Now, how do we set this up for the Nifty? Stop losses, absolutely critical for the day trader, Doc.
Yes, because the Nifty is trading at, let's say, 5,500, 6,000, 5,000 levels. You know, even a small percentage of volatility would mean about 50 rupees, 75 rupees, 100 rupees. Now, it becomes very difficult to go in that kind of fashion. Of course, that is one way to go. If you want to do it on a chart, I have a simple method which I have devised and which I use effectively every day of my trading life, is to set a stop loss 2 swing backs earlier from what we have. Let me explain to you with the chart what I mean by 2 swing chart. Now, here is a chart of Nifty, right? Now, here I have a setup where I have a breakout from, let's say, a sideways congestion. So where I mark this arrow, that is the place where we look to buy this. Now look, earlier to this, there is a swing low here, and prior to that, there is another swing low, which I marked as swing lows 1 and 2. Now I just set my stop loss 2 swing lows prior to my entry. So I will have a stop which is below this. Right? So this will have a certain amount of money at the exposure. That is something I have to be prepared to give.
And this is what, the day before, the 2 days before?
This really doesn't matter. It's just 2 swings before. It may be 2 days before, it may be 2 weeks before. That is really irrelevant. It is something which the market has generated. And I'm happy to look at market generated supports than trying to set something of my own. Right? My own is just my own. But something which is from the market is something a lot more significant. Now the critical thing is, as you will see on the chart again, is that as the prices start moving, these swing lows start coming up, you know, and I always keep my stop loss 2 swing lows earlier. See, these horizontal arrows which are marked on the chart are all 2 swing lows. And if you will study such a chart critically, I think you can do this on any chart of your choice, you will find that the market generally breaks 1 swing low but never 2 swing lows. So the 2 swing low things become very, very easy way, and it's a nice way of setting a trailing stop. And it's only when the trend changes, which you can see right at the end of the chart here, it's only when the trend changes that 2 successive swing lows get broken. So what you entered here, all through this, never ever broke 2 swing lows. It just broke 1 swing low. So your trade is on, and when it comes down and has this large, sharpish kind of fall, that's when it breaks the last 2 swing lows. And here is where you get off.
And these are trailing swing lows. You just keep
these
breaking
are trailing swing lows. This is a half-hourly chart of the Nifty. So this is something a day trader can follow with great deal of ease. This also helps to keep him in your trade for several days. Sometimes when you have a trend like this, being a day trader does not mean you need to close it out in 5 minutes. If the move is there, a day trader can also, convert into being a swing trader, but only when the market allows it.
Right. Okay, so now we have a good idea about setting stop losses. The next element to know is, how do you set your targets? Because at the end of a trading day, you want to actually get your profits before they go off the table, because quite often they might just disappear before you actually get the money in hand. So Doc, if you're looking at setting targets, how would you do it?
Well, again, we use simple techniques of technical analysis. 2 of the simplest one which we have discussed earlier on our show. One is the trend line channel-based technique, and other is a target-based technique using Fibonacci ratio. So let me show you the trend line here first on a chart. I have the chart of Nifty here, and on this I have these 2 highs which I have defined through a trend line. Now once I have a trend line, I can also draw a channel line. Now this is a lower top, so I am looking for the market to come lower. So if I go short somewhere here, I can draw a channel line and look for the price to achieve a target there. So whatever I short on the bar down here, this is the sell bar clearly. I can look to take it off here. Now it rallies again, so I draw a new trend line, and here is a new channel line. Right? The new channel line will become the new trigger line. Now this trend line will act as my stop loss, and I can move it out anyway if I'm using this as a full-fledged trade. And the other method which I have is something which we can use based upon your fib series of retracements and projections. So the same chart of Nifty I'm showing you now with a projection using the Fibonacci ratio. I have this down as my first reference swing, and I have this as my reaction swing upward. So I take this, I make a price multiple, I then project it down from here. I find that the first level of the decline stopped at the 1 multiple. This is something we discussed earlier on our show. And the second target which I have is at the 1.618 multiple, and it looks like the prices are headed down there. So I can use a fib ratio projection or a trendline channel. There are of course other multiples, but these are two very, very simple things to use which you have on any software, and you could use it with great deal of simplicity and ease.
Okay. One question, a lot of people wonder whether they should go into day trading, whether they should go into swing trading, or they should be long-term investors. Now, it's very difficult to put targets in terms of the returns that you can get, because it depends A, on the risk, B, upon your own capabilities.
Yep.
But what do people usually look at in terms of numbers to keep at the back of their mind if they're looking at day trading? If you're a good trader, what is it that you can make? And if you're a good swing trader, what could you make on a good day or for a good run?
See, I think if you look at trading per se, you're taking more risk, right? The shorter the time frame trader you are, the more the risk that you're running. So clearly the payoffs have to be significantly higher if you're going to be in shorter term trading. So as a day trader, you should be making significantly larger amount of money than you would make as a, let's say, an investor. As a normal investor, a return of 20-25% is deemed to be very, very good. So I think as a day trader, you must look at least about 5 to 10 times of that. Unless you're getting something like that on a consistent basis, it's not really worth the effort, the tensions, the hard work, and the stress that goes into it. And stress does goes into it. There's no doubt about it. So you should really be looking at 5 to 10 times that. So you're talking about 200% a year.
And
which is possible. It looks humongous, but it is possible.
It is possible. And in your experience, day traders, when they burn their fingers, how much can they go down? I mean, obviously they can completely wipe out trading equity, but
Absolutely.
What percentage of the time do you see that happening in your own experience?
I think I would say, you might think I'm being cynical about this, but I would think about 80% of the day traders simply wipe themselves out. That's because A, they have no plan, B, they have no strategy, C, they have no risk control measures, nothing. They just come in and take shots at it and hope for the best.
Right. For a good day trader, 200% is possible, and for 80% though of day traders that we see on our own Indian markets, they do go ahead and wipe out their entire equity. So you have to be careful about what your own trading psychology's profile is and whether you have the skill set for it. Well, it's that time of the show when we tell you really what's inside the mind of a trader, and today it's been a day trading special. It's a big question. I'm sure many of you ask yourselves whether you have it inside you to be a trader, and more importantly a day trader, because you have to give it a lot. You have to be with the markets between trading hours, from morning to afternoon. It's not an easy job, and there's a lot of risk. You need to have the stomach for it. So let's get inside the mind of a trader and figure out what it is that the professionals do and how they do it right.
Visual trader. I could never adopt Buffett's approach, for example, which is digital, using data to come to a decision. I need to see a chart in order to come to a decision, so it suits my personality right down to the ground. I think what it's taught me is not to block out information that goes against my preconceived notions. So it's very important when I trade that I look at the market and let it tell me what it wants to do. And whilst I might form a single scenario, the information coming in forces me to change my ideas, and that has served me in good stead in life. Firstly, we need to have market understanding. We have to have some way of defining an edge in the marketplace. So you might call that a written trading plan with an edge, or a written strategy with an edge. Then you need to have risk management, and I think this is what distinguishes the professional from the retail trader. They know how to manage their risk. And finally, there's a consistent application of both the written trading strategy and the risk management. So I think those three things are the ones that mark a good trader. More current hero or more current good trader would be Paul Tudor Jones. Again, probably one of the largest hedge fund managers in the world, and what he's done in his own trading is phenomenal. I guess Livermore's reminiscent, or Lefebvre's book about Livermore, Reminiscence of a Stock Operator, is probably my favorite book.
Okay then, time now to look at a chart quiz for last week. We'd asked you to give in your replies about how you expected the Nifty to move, as also HDFC Bank, and here are the replies that we've picked.
Lots of entries got it right, so I don't want to name one very specific entry. Snail Sangvi, Zubin Zaveri, Vishal Master, Sudin Bathija, so many of you got it very well. Your analysis was right on the button. The way you had done it was very nice. I think it was really very good work. All of you got right almost to the exact point, that 433 low in HDFC Bank. One or two points that I want to bring out in this. One is, everybody had this 433 rupees forecast for HDFC Bank. But what I want to really ask you out there is how many of you were able to trade it? You got the thing right down to the last penny that it dropped down to. And, the stock has gone up by about 8-10% in a matter of just one or two sessions. If you are not able to trade it, then the whole thing becomes an academic exercise. The second point which I want to bring out is the fact that I want you to think back to all the stocks that we have looked at, Infosys, Larsen & Toubro, HDFC Bank, State Bank of India. And everybody got their view on this more or less right. We are all uniformly bearish. But what I want you to focus on is the fact that each of these is a large cap stock which suffered about 20-30% decline from the highs. They were tradable. We should not be thinking that only the mid-cap stocks fall big time. It's also the large-cap stocks also fall big time when the trend is around. So we must be able to trade, whether it's large-cap or mid-cap, we must be able to trade them when the time is appropriate. I leave you to think about that, converting your analysis into appropriate action. That's the key to the whole game.
Well, it's interesting to see how our viewers have really progressed as our show has progressed with the kind of tools that they're using for the analysis. It's really good to see really top-class performances coming in from them. Let's look at what the chart quiz for next week is going to be on. It's going to be the Bank Nifty and Orchid Chemicals. Those are the two that you need to look at, pick your brains, and then your expectations of how you see they will be moving. All right, with that, we've come to the end of this show. We hope you enjoyed this day trading special and figure out for yourself whether really day trading is for you or not. And if it is, then I hope you've been able to pick up some useful tips to help you spin out some money-making trades. Well, for today, it's goodbye, then we'll see you again next week.